Are you tired of working hard for every dollar you earn? Well, stick around because today I'm going to show you how to start making your money work for you by investing in the stock market. Whether you're a newbie or just need a refresher, we're breaking it down step by step. Oh, and spoiler alert, there's no hidden sales pitch or secret course you need to buy at the end. Just pure, unadulterated financial wisdom. I'm Daniel, and welcome back to Mr. Investor, where we make finance fun, simple, and a little bit hilarious. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on the next big investment secret. So why invest in stocks? Let me put it simply, passive income. Imagine earning money while you sleep, sip coffee, or binge watch your favorite TV show. Passive income is the holy grail, folks, and investing in stocks is one of the best ways to achieve it. You buy a piece of a company, and as long as they do well, you get paid dividends. It's like having a tiny money-making machine working 24/7. First, let's get the basics down. What exactly is a stock? A stock is essentially a tiny piece of ownership in a company. Think of it like owning a fraction of a slice of pizza. Only this pizza could keep getting bigger and more delicious over time. For instance, owning a stock in Coca-Cola makes you a part owner of the entire Coca-Cola empire. That's right. Every time someone buys a Coke, you're making money. Move over, Warren Buffett. All right. Now let's talk about how to actually get started. To buy stocks, you need a brokerage account. This is your gateway to the stock market. Gone are the days of shady Wall Street brokers. Now, you can use online platforms like Robinhood or Webull, which are super user-friendly and commission-free. Or if you want something more traditional, try out Charles Schwab, Fidelity, or TD Ameritrade. Signing up is as easy as setting up a new social media account and way more beneficial for your financial health. Now here's where it gets interesting. There are 4 main styles of investing, and each has its own flavor. We'll start with dividend investing. This is where you buy stocks that pay you dividends, a portion of the company's profits. It's like having a golden goose that lays cash eggs every quarter. But beware, don't just chase the highest dividends. Look at the company's payout ratio, earnings, and dividend history. For instance, Coca-Cola has been paying reliable dividends since the 70s. Pretty sweet, huh? So, what should you look for in a dividend stock? First, the dividend yield. This tells you how much you'll earn per dollar invested. Coca-Cola, for example, has a yield of around 2.86%. Next, check the payout ratio, how much of their earnings they pay out as dividends. Coca-Cola's is pretty high at 82%, meaning they give a lot back to shareholders, but high isn't always better. You want a company that also reinvests in itself to grow. Look at their earnings history and their consistency in paying dividends. Websites like Yahoo Finance and Macro Trends can give you all this info at your fingertips. Some popular dividend stocks to consider include 3M, MMM, Johnson & Johnson, J&J, and AT&T. Each has a solid track record of paying dividends and can provide a steady stream of passive income. But remember, dividends are just one piece of the puzzle. The main advantage here is reliable income, but the downside is these companies might not grow as fast as others. Next up, let's talk value investing. Warren Buffett's bread and butter. This style is all about finding stocks that are undervalued. It's like shopping for bargains, but instead of clothes or gadgets, you're hunting for underpriced stocks. The key is to determine the intrinsic value of a stock and compare it to its current price. If the price is lower than its value, you've found a deal. A handy tool here is the price-to-earnings PE ratio. This compares a company's stock price to its earnings. A low PE ratio means the stock is cheaper relative to its earnings. For instance, if Coca-Cola has a PE ratio of 29, it means you're paying 29 times their earnings. Compare this to the market average, which is also around 29.3, and you'll see Coca-Cola is fairly priced, not necessarily a bargain. Value investors often look at stocks like Alibaba, Berkshire Hathaway, and bank stocks. These have been known for their potential to offer good value at a lower price. But remember, just because a stock is cheap doesn't mean it's a good buy. You have to dig into the financials and the company's future prospects. Now let's dive into growth investing. This is for those who love a bit of thrill and are willing to take on more risk for the chance of higher returns. Growth investors look for companies with big future potential. Think Tesla, Amazon, or any company that's disrupting its industry. You need to ask yourself, is this company innovative? Is it a game changer? When evaluating growth stocks, focus on revenue growth, return on equity, ROE, and profit margins. Take Tesla, for example. Their revenue has been growing year after year, and they have a solid ROE of 15.6%. Compare that to their competitors, and you'll see why they stand out. But growth stocks can be volatile. If a recession hits, these stocks might take a hit, but the potential for high returns is much greater. Some hot growth stocks to check out include Coinbase, Intellia Therapeutics, Palantir, and of course Tesla. These companies are leading the charge in their respective fields and have the potential for significant growth. Just be ready for a bumpy ride. Lastly, there's passive investing. This is the set-it-and-forget-it method, perfect for those who don't want to spend hours analyzing stocks. You invest in index funds, which are essentially baskets of stocks that track a specific market index. For example, the S&P 500 Index Fund tracks the 500 largest companies in the U.S. This strategy is so effective that even Warren Buffett recommends it to most investors. To invest in an index fund, simply buy shares of the fund through your brokerage account. It's that simple. No need to stress about picking individual stocks or timing the market. Plus, index funds often outperform actively managed funds over the long term. Now you might be wondering, Daniel, what's the catch? Well, the catch is that you have to be patient. Investing is not a get-rich-quick scheme. It's more like planting a tree. You plant the seed, water it, and over time, it grows into a strong, sturdy tree that provides shade and money for years to come. So start early, stay consistent, and let time do the heavy lifting. All right, let's summarize. First, decide which investing style suits you best: dividend, value, growth, or passive investing. Do your homework, learn all you can, and start small. Dip your toes in by buying your first stock or index fund. Remember, the key is to start and stay consistent. Investing is a marathon, not a sprint. And for those worried about high stock prices, remember, think long-term. The market has its ups and downs, but quality stocks tend to rise over time. If there's a crash, don't panic. See it as a buying opportunity. Another tip is to diversify your investments. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes. This way, if one investment performs poorly, others can help balance it out. Think of it as creating a financial safety net. Also, keep an eye on the news and stay informed about the companies you invest in. Things can change quickly in the business world, and staying updated can help you make better investment decisions. But remember, don't let short-term market fluctuations scare you. Focus on the bigger picture. Finally, consider automating your investments. Many brokerage platforms offer features that allow you to set up automatic investments on a regular schedule. This is a great way to ensure you stay consistent and take advantage of dollar-cost averaging, which can reduce the impact of market volatility over time. That's it for today, folks. I hope you found this breakdown helpful and entertaining. If you did, make sure to like, comment, and subscribe to Mr. Investor for more tips and tricks on making your money work for you. Happy investing, and see you in the next video.